Hello, it's Adil bringing you a review of the US markets from an intermarket analysis perspective, starting with regards to the 29th of September 2014 for Monday's trading. Okay, so where are we? Okay, so we finished the week off off the low with the stronger GDP data. The main, obviously, highlight there was business investment. Going forward, that should expectations there of obviously creating new jobs, capital investment, business investment. Obviously, that bodes well because obviously, if companies are confident enough to invest, that means that they must obviously be achieving or looking to achieve higher growth, higher exports, okay, higher production. Therefore, they need increase the labour for that production, and that's the reason why. Okay, so the week itself, from fundamental perspective, obviously we had a hawkish stance with regards to the US dollar, obviously moving higher, and that can be exemplified with the US dollar index. So you have the US dollar index obviously coming into or taking out double top resistance. Excuse me. Okay. Excuse me again. Okay, so basically we have the US dollar index, obviously this move higher here, concerted move higher here. Obviously higher interest rates obviously mean that tapering phase obviously come back, and that itself can hurt emerging markets, okay, because of the restriction to liquidity or the access to capital, okay. So the cost of capital is rising, and that obviously will hurt obviously companies going forward. And given the fact that the US dollar obviously is moving higher, that's obviously hurting US exports. So there's a lot of reasons there for, or a lot of arguments there for the markets to be bearish, okay, with regards to especially the US market. So hawkish stance from that perspective, or in the markets are interpreting as being hawkish, and with regards to the economic data that comes out, okay. And not only that, we had concerns with regards to Mr. Zhu, whether or not he'd be replaced. Then we had durable goods orders worse than expected. Then we had some article regarding the Russians seizing assets that obviously spooked the markets as well. So it was quite a very volatile market. Then we had concerns with regards to Apple, obviously the iOS 8 floor and the Bengate floor with the form bending. So again, that obviously with it being heavily weighted on the US markets, that again had a negative impact. So there were a lot of variables that came out during the week that were obviously negative and cause the markets to sell off quite considerably. Okay, so that's basically what we're expecting there. Obviously European data, German confidence data obviously wasn't spectacular, okay, and Eurozone data overall wasn't exactly spectacular. Japanese data was poor as well, okay. We had some poor week data during the week, and obviously we had risk FX, so Aussie and Kiwi continues to move lower given the uncertainty regarding the PBOC, and obviously jawboning by the central banks as well. So adding the fact that you had a hawkish dollar, and that exacerbated the move even more. So we also had Chinese data come out. Some data came out in line, other data was weaker than expected. So overall it's not good. And even obviously today's data that's come out today, Chinese industrial profits have come out much worse than expected. So again, the theme there seems to be China slowing down. China obviously needs to be the leader, not a laggard, okay. And then we have US markets that are obviously stagnating, and you have Europe certainly being felt or hurting with regards to the Russian sanctions and general deflationary phase in the Eurozone. So there's a lot of factors there, arguments that you can point towards the downside. Then you had the FTSE 100, which I've already explained in the previous video, was hit by Tesco, hurt by the tax inversions, obviously with regards to the British pharmaceutical sector and obviously the US pharmaceutical sector. So these are all scenarios or situations where the market obviously will certainly remain under pressure. Adding the fact that the ISIS or the attack in Iraq and Syria and the bonds that are being thrown there, obviously there could potentially be repercussions, and again that's negative for the market. Anytime you have war, it always creates a negative, okay, especially from the outset. Whether or not the war itself is controllable, etc., and allows the markets to rally, that's a different situation altogether. Okay, so now that I've giving you a backdrop with regards to the fundamentals. Let's have a look at the technicals now and let's see exactly where this market's going. Okay, so Dow Transportation Average, H&S formation. Be very careful. Okay, to be very, very careful. Anybody who's bullish on the Dow Transports right now, it's certainly not a good idea. Okay, from my perspective. One of the reasons why that's not a good idea is because the Dow Transports generally are dictated by the price of oil. Okay, and well, not primarily, but generally speaking. And given the fact that the USO, if you look at the USO, even though the US dollar index itself is certainly into resistance, I mean that's certainly a variable that one could utilize. But from my perspective, and this itself is certainly gearing up for a potential break. Okay, symmetrical break, and given the fact that the geopolitical concerns that we have in the Middle East, well, yes, in the Middle East, such as Syria, Iraq, and the wider region, that will obviously be supportive of the oil price itself. So expect the UUP itself is the USO, so to say, the USO, the price of oil certainly to propel higher up to the 35.75 level, if not touching the 200 MA. So bias certainly remains bullish with regards to oil or USO. And obviously, given the fact that the Dow Transportation Average has an inverse relationship to the price of oil, and obviously that itself will certainly confirm this H&S formation as well. Okay, so that's using intermarket analysis and trying to understand exactly what's happening here. So from my perspective, yep, right shoulder is being put in for now. Okay, so that's bearish. We can cross-reference that with the Dow itself. So let's just bring the Dow. Okay, here we go. So daily chart again, same pattern. Okay, so you can see here this is your head, okay, which is there. So your left shoulder is there, your head is there, right shoulder is being formed, it's an inside bar. So we're looking for a potential move down to if we take 1943, you're taking 1943, 1745. So you're looking at almost a 100-point drop, basically. What are we on now at the moment? So this is Dow Jones, 16, 60. Yeah, so basically looking at around 14,000 level, if that. Certainly looking like it's going to be quite a considerable move. What we at 16,350, 17,350. So that's a 1,000-point move, yeah. So you're looking at 15. So that's quite a substantial move. Okay, so you're looking from 300 down to the 400 to 500-point move. So definitely looking around the 200 MA on the downside. Okay, so keep an eye out for that with regards to the Dow Jones, certainly under pressure. Now we look at the Nasdaq, see exactly what's happening there. Nasdaq inside bar, potentially breaking this key pivotal trend line that's been holding for quite some time now. Okay, we can have a look at the semicons. Semicons again inside bar, potentially a H&S formation looking like it's brewing there as well. Let's have a look at the its partner. Let's have a look. That's your semicons. Okay, all we need now is got the Nasdaq, and you need the biotechs. Okay, so the biotechs, looking at the chart of biotechs again, double top resistance, quadruple top resistance, and certainly an inside bar there as well, potential move lower. So those three European indices I've shown you certainly remain bearish, and that's basically what I'll be looking to trade come Monday with regards to that bias that I have obviously got at present. Okay, so the next step now, given the fact that we looked at the technology stocks, we look at the Russell and the S&P. Russell itself, as we all know, everybody's talking about the potential break of the H&S formation, which obviously has been broken. We are testing this potential support. It's an inside bar, and next move certainly looks like it wants to propel lower. Okay, so if you confirm that with the S&P 500, the S&P 500 now, if you look at the S&P 500, the market is no longer making higher highs, higher lows. It's making lower lows, lower highs, and now we have consolidation in the lower 25%. So therefore, that's generally classed as a bear flag scenario. We're just consolidating, especially given the fact that light volume Friday, and this market certainly could pull back to the 1940 level, if not lower. Okay, So that's basically, I'll be looking for 1940, definitely lower, definitely lower, but for 1940 will be the key, okay, for the interim. Okay, so that's basically US markets in a nutshell. Okay, as you can see, they all point down from a technical basis, from a fundamental basis, given the fact that the situation in Iraq and the Syria situation certainly is ongoing, and the bombs are being dropped there. Unfortunately, let's just hope that there's only the the imbeciles that get taken out, not the innocent individuals. Okay, so then you have many more currents, which I'm not going to elaborate for now, and I think that'll be sufficient for this video. So risk on, risk off, wax on, wax off. Goodbye now.